The Federal Reserve's decisions are a seismic force that can make the stock market tremble. And history has proven this time and again. From the mid-20th century to the brink of the third decade of the 21st century, the Federal Reserve has made numerous pivots, shifting the tectonic plates of the financial world. Casting our minds back to the 1940s, a significant pivot occurred in 1946. After a period of steady interest rates, the Federal Reserve decided to lower them. What followed was a substantial fall in the stock market within 3 months, showing the first evidence of the impact Federal Reserve decisions can have on the stock market. Fast forward a decade and we find ourselves in 1958. Once again, the Federal Reserve lowered interest rates after a period of stability. The result? The stock market took a sharp nosedive within the following 3 months, reinforcing the pattern observed earlier. As the 1960s rolled around, the Federal Reserve repeated the same maneuver in 1966. True to form, the stock market responded with a significant slump within 3 months, underscoring the gravity of the Federal Reserve's decisions. The pattern continued into the 1970s. In 1974, the Federal Reserve once again pivoted, lowering interest rates. This move was met with a steep decline in the stock market, marking yet another instance of the Federal Reserve's influence over the financial market. In the 1980s, specifically in 1981, history repeated itself. The Federal Reserve lowered interest rates and the stock market reacted with a notable dip within the next 3 months. The 1990s saw a similar story unfold. In 1998, the Federal Reserve made the decision to lower interest rates. Predictably, the stock market fell substantially in response within 3 months of the pivot. The new millennium did not alter this pattern. In the early 2000s, the Federal Reserve made significant pivots, notably in 2001 and 2007. On both occasions, the stock market suffered considerable losses within 3 months of these decisions. Most recently, in the second decade of the 21st century, the Federal Reserve lowered interest rates in 2018. The stock market reacted accordingly, with a significant fall within the subsequent 3 months. To summarize, the instances from 1946 to 2018 provide clear evidence that the Federal Reserve's decisions, specifically its pivots, have a profound impact on the stock market. Each pivot, marked by a lowering of interest rates after a period of stability, has led to a substantial fall in the stock market within 3 months. This trend underscores the pivotal role the Federal Reserve plays in the financial market, a role that continues to shape the fortunes of investors and economies alike.